The morning trading floor roared with panic as bond prices collapsed in real time. What was supposed to be the safest market in the world suddenly turned violent. Television screens flashed the words, "Bond Bloodbath." Anchors struggled to explain how U.S. Treasury securities were plunging. Just weeks earlier, investors believed interest rates would stay low for years. Instead, the Federal Reserve had fired the first shot. On February 4, 1994, the Fed raised short-term interest rates by 25 basis points. It was the first increase in 5 years. The decision was led by Federal Reserve Chairman Alan Greenspan. Markets had not expected him to move so soon. And there was almost no warning. In 1994, the Fed did not issue detailed forward guidance the way it does today. Bond yields immediately spiked. Prices, which move in the opposite direction, fell sharply. Within months, global bond markets would lose over $1 trillion in value. Investors were stunned by the speed of the damage. The crash of 1994 would become one of the most violent bond sell-offs in modern history. Yet today, few remember it. To understand the shock, we must go back to the early 1990s. America was recovering from the 1991 recession. Inflation was low and stable. Investors believed the era of calm had arrived. Under President Bill Clinton, deficit reduction became a central goal. Fiscal discipline reassured global markets. Wall Street banks expanded complex bond products. Structured notes promised higher returns with little apparent risk. At Salomon Brothers and Goldman Sachs, bond desks grew powerful. Leverage quietly increased across the system. Mortgage-backed securities were widely held. Pension funds and mutual funds loaded up on long-duration bonds. Duration risk was misunderstood. Few expected interest rates to move quickly. Global capital poured into U.S. treasuries. The dollar was seen as the ultimate safe haven. Bond mutual funds marketed stability. Retail investors chased steady income. But beneath the surface, leverage amplified every basis point move. A small rate increase could trigger outsized losses. Even sophisticated hedge funds were exposed. Many relied on borrowed money to enhance returns. Markets had grown complacent. Confidence replaced caution. Then came February 4th. The calm ended instantly. The federal funds rate target was lifted from 3.00% to 3.25%. It was only the beginning. Over the next 12 months, rates would rise 7 times. The tightening cycle shocked global markets. Bond yields surged sharply. The 10-year Treasury jumped nearly 200 basis points during the year. Losses accumulated rapidly for leveraged portfolios. Margin calls intensified pressure. Structured notes began to implode. Dealers struggled to price complex derivatives. One hedge fund after another reported heavy losses. Liquidity began to dry up. What began as a quarter-point hike was turning systemic. The safest asset in finance had broken trust. And the worst was still ahead. In California, a county treasurer was about to make history. In Orange County, California, Treasurer Robert Citron believed he had outsmarted the market. Instead, he was sitting on a financial time bomb. Citron had borrowed heavily to invest in structured notes known as inverse floaters. These instruments magnified returns when rates stayed low. But when interest rates rose, the math reversed brutally. Losses accelerated with every rate hike. By late 1994, Orange County's investment pool had lost over $1.6 billion. The shortfall was catastrophic. On December 6, 1994, Orange County declared bankruptcy. It became the largest municipal bankruptcy in U.S. history at that time. Robert Citron later resigned and pleaded guilty to filing a false financial statement. Trust in public fund management was shaken nationwide. Meanwhile, in New York, another crisis was unfolding. Askin Capital Management was collapsing under bond losses. The firm specialized in mortgage-backed securities. When prices fell, its leverage amplified the damage. By April 1994, Askin Capital was effectively insolvent. Creditors seized control of its assets. Wall Street dealers were forced to absorb heavy losses. Liquidity in complex bond products vanished. Major institutions including J.P. Morgan and Merrill Lynch reported significant bond trading losses. Risk models had failed to anticipate such volatility. Structured note markets froze. Investors refused to buy instruments they no longer understood. The shock did not remain in America. Global investors began pulling capital from emerging markets. Mexico was especially vulnerable. Foreign capital had poured in during years of optimism. When U.S. rates rose, investors fled Mexican assets. Pressure mounted on the peso. In December 1994, the peso was devalued. Panic spread through global markets. The crisis became known as the Tequila Crisis. It threatened to destabilize Latin America. The United States intervened to prevent contagion. Treasury officials moved quickly behind closed doors. Treasury Secretary-designate Robert Rubin helped coordinate a rescue package. Stability was now a geopolitical priority. The bailout package totaled roughly $50 billion. It involved the U.S. Treasury and the International Monetary Fund. The intervention stabilized Mexico, but investor confidence was shaken worldwide. Emerging markets would never look the same again. The 1994 bond crash had become more than a domestic event. It was a preview of future global crises. 3 years later, Asia would face its own currency collapse. 4 years later, Russia would default. The bond market shock of 1994 had revealed a new truth. Capital could flee faster than governments could react. And yet, the Federal Reserve continued tightening. By early 1995, rates had doubled to 6%. Critics questioned whether the Fed had moved too abruptly. Supporters argued it prevented inflation from reigniting. Markets slowly adjusted to higher rates. Volatility began to settle. But scars remained. Investors had learned a painful lesson about leverage. The bond crash of 1994 reshaped risk management. Transparency would soon become central bank doctrine. Yet the most profound changes were still ahead. Wall Street was about to reinvent how it measured danger. By late 1994, Wall Street was no longer in denial. The bond market had delivered a historic shock. Losses rippled through major firms. Trading desks were forced to reassess everything they thought they understood. At institutions like J.P. Morgan and Merrill Lynch, risk committees met behind closed doors. Internal models had failed to predict the speed of rate increases. Duration risk had been underestimated. Leverage had amplified what should have been manageable losses. Structured notes and mortgage derivatives were suddenly viewed with suspicion. Investors demanded clearer disclosure. The crash accelerated the development of modern value-at-risk models. Banks began quantifying worst-case scenarios more aggressively. Regulators took notice. The complexity of derivatives had outpaced oversight. Congressional hearings questioned whether Wall Street had fully understood its own products. Public confidence required answers. But perhaps the most lasting reform came from the Federal Reserve itself. Communication began to change. Before 1994, policy shifts were often opaque. After the crash, transparency gradually became central doctrine. Forward guidance was born from crisis. Markets would no longer be left completely guessing. The 1994 experience reshaped how central banks communicated globally. It became a model for transparency in later decades. At the center stood Alan Greenspan. Was he too aggressive or precisely what the economy needed? The Fed raised rates 7 times between February 1994 and February 1995. The federal funds rate doubled from 3 to 6%. Supporters argued that tightening prevented inflation from reigniting. The economy would soon enter one of the strongest expansions in history. Critics countered that markets were blindsided. The shock exposed systemic fragility. Yet unlike 2008, no major U.S. bank collapsed outright. The system absorbed the blow. The pain was sharp but contained. Lessons were learned without systemic ruin. Today, the 1994 bond crash is often overshadowed by later crises. But it was a turning point. It revealed how quickly leverage can unwind, and how interconnected global capital truly is. From Orange County to Mexico City, the consequences were real and personal. Families, governments, and institutions felt the strain. The crisis reshaped central banking. Transparency became policy, not preference. Risk management evolved. Financial engineering would never again be viewed as harmless innovation. The bond market had sent a warning. Markets could punish complacency without mercy. In 1994, the safest investment in the world became a source of fear. U.S. Treasuries reminded investors of a timeless truth. Nothing in finance is truly risk-free, not even government debt. The forgotten crash of 1994 reshaped global finance quietly. Its legacy lives in every policy statement issued today. It was not a collapse of banks. It was a collapse of assumptions. A quarter-point move triggered a global chain reaction. The world learned how sensitive modern finance had become. And in that lesson lies the enduring legacy of 1994, a reminder that stability is often an illusion.